Welcome back to XTRM Finance, where we make complex financial topics simple and fun. Today we're tackling a question that confuses a lot of retirees. How does capital gains tax affect your Social Security benefits? I know, taxes on your hard-earned money can be a bit of a downer, but stick with me. By the end of this video, you'll understand exactly how capital gains can impact your Social Security checks, and more importantly, how to avoid unnecessary tax bites. Let's get started. Okay, let's start with the basics. Capital gains tax is the tax you pay when you sell an investment, like stocks, bonds, or real estate, and make a profit. The profit you earn from that sale is considered a capital gain. There are two types of capital gains. One, short-term capital gains. These are profits from investments you've held for less than a year. They're taxed as ordinary income, meaning they can get taxed at your regular income tax rate. Ouch. 2. Long-term capital gains. These are profits from investments you've held for more than a year. These are taxed at a lower rate, usually 0%, 15%, or 20%, depending on your income. So, long-term gains are a little friendlier to your wallet. Now here's where it gets interesting. Capital gains tax doesn't directly affect your Social Security benefits, but it does indirectly impact how much of your Social Security income gets taxed. Yes, it's a bit of a double whammy. Here's how it works. When you file your taxes, the IRS looks at your combined income to determine how much of your Social Security benefits will be taxed. Combined income is made up of your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. And guess what? Capital gains are included in that AGI. So if you sell an investment and make a profit, that income gets added to your combined income, which can push your Social Security benefits into the taxable zone. Let's break down the thresholds, because this is where things get tricky. Depending on your filing status, your combined income determines how much of your Social Security benefits are taxed. Here's a quick look at the thresholds for single and married filers. For single filers, if your combined income is under $25,000, none of your Social Security benefits are taxed. Between $25,000 and $34,000, up to 50% of your benefits may be taxable. And if it's over $34,000, up to 85% of your benefits could be taxable. For married couples filing jointly, if your combined income is under $32,000, there's no tax on your Social Security benefits. Between $32,000 and $44,000, up to 50% of your benefits are taxed. Over $44,000, up to 85% of your benefits can be taxed. Now, if you're sitting on some nice capital gains from selling investments, those gains could easily bump you into the higher tax brackets and make more of your Social Security taxable. Let's say you sell a stock you've been holding for a while and make a $15,000 profit. If your combined income is already near the edge of the threshold, that $15,000 capital gain could push you over the limit. This means a larger portion of your Social Security benefits could be taxed at 50% or even 85%. The key takeaway here is that capital gains can increase your combined income, and as a result, increase the amount of your Social Security that's taxed. And trust me, you don't want to be surprised come tax season. Now let's talk about how to avoid getting slapped with higher taxes on your Social Security benefits. It's all about strategic planning. Here are a few strategies to minimize the impact. 1. Time your sales carefully. If you can, consider timing your capital gains for a year when your combined income is lower, so you don't push yourself into a higher tax bracket. 2. Tax-advantaged accounts. Consider keeping your investments in tax-advantaged accounts like a Roth IRA or 401k. Capital gains in these accounts don't count toward your taxable income, so you won't have to worry about them affecting your Social Security. 3. Tax loss harvesting. This strategy involves selling investments at a loss to offset capital gains. It can reduce your AGI and keep your Social Security benefits from being taxed more than necessary. 4. Manage withdrawals. Be mindful of how much you're withdrawing from your taxable accounts. You might want to limit your withdrawals in years when your Social Security benefits are more likely to be taxed. Let's look at an example. Meet Jane. Jane is retired and living on her Social Security benefits, but she also has a small portfolio of stocks. One year, Jane sells some of her stock holdings and makes $20,000 in capital gains. Her combined income goes up, and suddenly, 50% of her Social Security benefits are taxable, pushing her tax bill higher. Now meet Bob. Bob is in the same situation, but he has a tax strategy in place. He plans his stock sales carefully, uses tax loss harvesting, and limits withdrawals. As a result, Bob keeps his taxable income low, and his Social Security benefits stay tax-free or only partially taxed. Moral of the story: a little planning can make a huge difference. Managing your taxes is tough enough without adding the complexities of Social Security and capital gains. If you're feeling overwhelmed, or you've got a larger portfolio, it might be time to sit down with a financial advisor. They can help you create a tax-efficient withdrawal strategy and ensure you're not paying more taxes than necessary on your Social Security benefits. And there you have it. Understanding how capital gains affect Social Security taxes is key to keeping more money in your pocket. So which strategy are you going to implement to protect your Social Security from higher taxes? Let me know in the comments. If you found this video helpful, give it a thumbs up, share it with someone who's close to retirement, and don't forget to hit that subscribe button for more tax-saving tips from XTRM Finance. Remember, taxes don't have to be scary when you know how to work the system to your advantage. See you next time. Until next time, keep your taxes low and your retirement funds high.